how banks manage to make billions of dollars every single year, because on the surface, the whole system looks like it works entirely in our favor. We deposit our hard earned money into banks, and then the banks actually turn around and pay us interest for the privilege. Just think about that for a second. They are literally paying us to hold our money. So, how on earth does that translate into massive wealth for them?
How do banks get richer while paying you? Seriously, if banks are essentially giving money away in the form of interest payments to their depositors, how do they become wealthier year after year? It seems like a massive contradiction, doesn't it? Giving away money logically shouldn't lead to making billions. But as you'll see, the answer is surprisingly simple and just incredibly efficient. Modern banking. Let's uncover the true business model
Part
of modern.
1. The Bank Vault Illusion. Safe storage versus reality.
You know, a lot of people think banks simply exist to keep your money safe, like it's a giant secure vault with your specific stack of cash just sitting inside, waiting for you. But that safe storage idea, it's kind of an illusion. In reality, banks operate as financial middlemen. They aren't just sitting on your cash. They're actively operating as the bridge between two entirely different groups of people in the broader economy.
Okay, let's dive into this. Part 2. The ultimate financial middleman. Savers and borrowers. So banks collect money from millions of everyday people who are saving their funds. Then they take that money and lend it right back out to people who need it right now. Imagine 1 million people each depositing just $1,000 into a bank. On its own, $1,000 isn't exactly a fortune, right? But when the bank pulls those individual deposits together, suddenly they have $1 billion available to work with. And instead of letting that $1 billion sit idle, just gathering dust in a vault somewhere, the bank puts it to work. Part 3. The power of interest spread, the core profit engine. So the absolute biggest way banks make their money is through interest. Let's break down a very specific micro example to see how this actually works in practice. Let's say you deposit $10,000 into a savings account, and the bank pays you a 2% interest rate for letting them hold your money. That means you'll earn $200 after 1 year just for leaving your money alone. Sounds like a pretty great deal for you, right? But the transaction absolutely doesn't stop there. Now, the bank takes your $10,000 and lends it out to someone else who is, say, buying a car or purchasing a house. But this time around, the terms are very different. The bank charges that borrower a 7% interest rate. So for that exact same $10,000, the borrower pays the bank $700 in interest over the course of the year. So what happens to the difference? And this brilliantly illustrates the magic of the whole system. The bank paid you $200, but they collected $700 from the borrower. The bank simply pockets the remaining $500 as net profit before covering its other operational costs. They made $500 using money that didn't even belong to them. Now scale that up. When this precise transaction happens millions of times every single day across the entire global financial system, that is how banks effortlessly earn billions of dollars from the interest spread alone. Let's move to and see how this builds. Part 4. An empire of tiny fees, beyond just interest. Because interest isn't their only source of income, not by a long shot. Banks earn money from credit card fees, ATM fees, monthly account maintenance charges, late payment penalties, international money transfer fees, business banking services, investment management, mortgage processing, insurance products, and foreign currency exchanges. On an individual level, a couple of dollars here or a percentage point there might seem tiny, almost insignificant. But when millions of customers are paying these tiny fees every single day, those small amounts snowball into absolutely enormous profits. It's literally an empire built entirely on volume.
Part 5. How banks create money. Macroeconomic reality. Now, what's really interesting about this slide is that banks do much more than simply move existing money around from one person to another. Through the very act of lending, banks can actually create new money. This often completely surprises people, but it's a fundamental part of how our modern macroeconomic system operates. They aren't just middlemen, they're active creators of capital in the financial system. So the crucial point is, suppose someone deposits $1,000. The bank keeps a small fraction in reserve, adhering to fractional reserve limits, but lends the vast majority of that money out to another customer. That customer takes the loan and spends it, maybe buying materials for a project. Well, the seller who receives that money turns around and deposits it right back into their own bank. And the cycle repeats. The new bank lends most of that newly deposited money out again. The initial $1,000 multiplies as it moves continuously through this cycle of lending and depositing, effectively expanding the total money supply in the entire economy. Because of this continuous, nonstop cycle of pooling funds, lending, and multiplying capital, banks play a massive, absolutely crucial role in the economy. Without them acting as our financial engines, things we just take for granted, like getting a mortgage to buy a home, securing capital to start a new business, and growing the broader economy, would be incredibly difficult, if not flat out impossible. The whole system exists to keep capital flowing and working, rather than just sitting uselessly under someone's mattress. So, you now know the exact mechanics and the secrets behind how banks generate immense wealth every single year. From charging the interest spread and collecting millions of tiny service fees to literally multiplying the money supply. But I want to leave you with a final thought to ponder next time you look at your own savings account. Your money is never just resting. It is always, always working. The real question is, who is it really working for? Thanks so much for joining me